Good day, viewers. Welcome to Momentum Investments' first episode of the quarterly economic lens. I am Tshiamo Masike, economic analyst at Momentum Investments, and with me today is Sanisha Packirisamy, chief economist at Momentum Investments. Before we start with the first episode, I just thought let me set the scene a bit, given that this is the first episode. The Quarterly Economic Lens is a platform where we will discuss economic events of the previous quarter, as well as provide some insights on what we can expect in the quarters ahead. New episodes will be available once a quarter in approximately 2 weeks from when the previous quarter wrapped up. So do stay tuned for more episodes. Just before we start, I think maybe, Sanisha, to start off, we can reflect back on the previous quarter. We saw it was quite eventful with some twists and turns. What were some of the major events that stood out for you?
Thanks, Tshiamo. Great being here with you today. I think there were two major events that came out. The first was the move by the Federal Reserve in the United States to cut interest rates for the first time in this cycle. It was a long-awaited interest rate cutting cycle that has now finally commenced. And the second big event was the 5th of August. And so quite interestingly, if you were sitting at your desk at the beginning of August and you came back at the end of August, it would have looked like nothing had happened. However, markets took quite a nosedive on the 5th of August, and this was predominantly on the back of the unwinding of the Japanese carry trade. And that was really because the yen had strengthened on the back of the Bank of Japan increase in interest rates, and investors out there were actually betting that monetary policy would remain stable for a little bit longer. However, the Bank of Japan saw an opportunity to raise interest rates because finally, after a very long time, they've managed to get wage inflation going again, and it looks as though they can get to that 2% sustainable level of inflation. Now, outside of these technical factors which drove the market lower, we also had some fundamentals in markets that had started to look like they were going to deteriorate. The first was on the back of geopolitical risks with Middle Eastern tensions that were hotting up. And we also saw a very poor set of data coming out of the US that was centered around the jobs market. And this really stirred a lot of concerns in the investor community. But as I've said, going back and looking at many years before this, we've often had these big market corrections. And given that it was mostly technicals driven, we believe that the fundamental structural picture of the global economy didn't really shift all that much during this time period.
I just want to take us a little back to and focus on the US labor market. We saw that the US labor market has been softening. The unemployment rate increased to 4.3% in July, but we did see an improvement back down to 4.1% in September. Centered around the US labor market is the debate around the soft versus hard landing. We're seeing a lot of those concepts being thrown around. Can you maybe just explain that a little bit more to us? And do we have an idea of what a soft landing looks like?
Sure. So, a hard versus a soft landing is a concept that investors use to describe how hard the economy will fall in an interest rate cycle. Now, there's no definitive concept saying that a soft landing is X% growth and a hard landing is X% growth, but it's generally assumed that a hard landing would fall in line with an economic downturn that the National Bureau of Economic Research would then classify and define as an actual recession. We've seen that former Federal Reserve officials actually look at a soft landing in the context of growth not contracting by more than 1%. And so if you take data all the way back to 1965 up until the COVID-19 crisis, you'd see that we probably only had about 4 actual soft landings in the US economy. So it's actually quite difficult for the Federal Reserve to engineer a soft landing. Now, if we look at the probabilities around whether we're going to get a hard or soft landing, these have also shifted quite a bit over the last while. So if we dial back about a year ago, the markets were anticipating almost a 60% probability of a recession occurring in the US economy over a 12-month period. And this is calibrated by the Bloomberg consensus numbers. So this was a time at which, economic data was surprising to the downside. But however, we got into 2024 and US economic data started to surprise quite meaningfully to the upside. And on the back of that, we saw that the recession probability started to decrease. And we saw that the markets were then paring back their expectations for interest rate cuts as the data looked stronger. And we also saw that core inflation measures were looking a little bit stickier. And that, of course, would mean that the Federal Reserve couldn't cut by as much. Then we entered that period of the August market wobble, and markets became a little bit concerned that maybe there's more weakness than what we are seeing in the US economy, and then started to price in a little bit more risk. However, the recession probability on that Bloomberg measure remained at 30%, so basically a 1 in 3 chance. So it's not completely dismissible. There is still that risk that prevails. But if we look at the underlying resilience of the US economy, and we know that the consumer is a very big chunk of growth in the US economy, we continue to see some strength being portrayed there, despite the fact that pandemic savings are running out. Going into an interest rate cutting cycle could also provide a little bit more support for growth as we start to see GDP now soften into the next years. We've come out of a period of very elevated growth rates in the US economy, far above trend. And on the back of that, we do expect some softening in growth measures to come through. So we're very much in the soft landing camp, as the markets probably are as well. If we look at what global equity markets did for the third quarter of the year, up 6.6%. So definitely not suggesting that a hard landing in the economy or full-on recession is impending.
Just touching back on, you mentioned the strength of the US economy and linking that also back to the robust labor, the payroll numbers that we saw in September. Would you then say that the 50 basis point cut that the Fed delivered in September was a mistake and they could have only delivered a 25 basis point cut?
Well, the Fed has been deeply criticized over the last while. Firstly, they were criticized for being behind the curve when they raised interest rates to fight inflation. And of course, we saw that big inflation wave hitting them. And then subsequent, when inflation started to fall and the economy started to show some cracks emerging, markets then assumed that the Fed had waited too long. I think we are now at a point in the cycle where the Fed has to juggle the potential for inflation to lift off a reasonably lower level than where it was before, but at the same time having to manage the underlying resilience of the economy. And just like all the other central banks out there, it is going to be a bit of a wait and see approach. We often hear central bankers saying that they are data dependent, and I think this is exactly what is happening. So you get one stellar payroll sprint and it almost changes the psyche of investors in terms of what they're assuming on interest rate cuts. So again, taking it back about a year ago when that recession probability priced in was 60%, the markets were looking for the Fed to cut between 5 and 6 times by the end of this year. When the data started to emerge in the beginning part of the year, looking a little bit stronger and core inflation was a lot stickier, the markets pared that back to between 1 and 2 cuts by the end of the year. We've now sort of evolved into a place where the markets are looking to about 4 interest rate cuts for the year, signifying that they are still a little bit worried about the underlying resilience of the economy.
So we do see that the globe is on a monetary policy easing cycle, but the Asian markets are evolving quite differently, as Japan has increased interest rates. And this is partly because they didn't implement stimulus packages that shot up inflation as much as in other countries. We also saw stimulus packages in China. Do you think that is enough to bring up the growth in the country?
Well, I think investors were waiting for this juncture at which, Chinese authorities would finally blink, given that economic data has been quite soft. And quite a bit has been done. They've spanned, numerous portions of the economy trying to target higher levels of economic growth. And it did surprise to the upside in terms of the interest rate cuts that they've put through and the commitment to further fiscal stimulus. However, if we really want to fix the underlying weakness of the Chinese economy, particularly on the depressed consumer sentiment side, we really have to fix the stream of permanent income for consumers. And I think that this quick fix is not the way to do it. We're also seeing, in terms of the measures that they're putting forward for the property sector, it won't necessarily arrest the continued downward spiral in the property sector. So while I think it is a positive that authorities have come out in a meaningful fashion and surprised to the upside in terms of their stimulus measures, and have announced a willingness to do more if necessary, I think that authorities probably do have to do more in the next couple of months in order to find a bottom on the property sector and to really spur consumer sentiment in a more meaningful way in a country that doesn't really have a very good social security or pension reform net.
Outside of markets watching monetary policy and the decisions of central banks, markets are also paying quite close attention to geopolitics, because we do say that geopolitics are hotting up. So the recent move with Israel, do you think that is enough to gather some support from Iran and other allies?
I definitely think in these latest moves from Israel's side that a significant tripwire has in fact been triggered. Israel has shown that they want to protect their borders in quite a meaningful way. And this, of course, has caused a lot of civilian deaths in Lebanon. We think that out of all the scenarios that could happen from here, we're probably likely to see more of a loss of life in Lebanon. I think at this stage, the scenarios kind of pan from the milder to the most severe. And in a milder kind of scenario, we continue to see Israel taking out more of that command structure of Hezbollah. And in that kind of world, it will also weaken Israel because there is a cost attached to that. That would be more of a ground incursion that continues. It could also be a case where they go to an air defense kind of system, and that might mean that they could take out the long-range military defense system from Hezbollah, and that would become more ineffective. I think the most severe outcome that the markets are not necessarily pricing in as a central or base case scenario right now is for Iran to back Hezbollah in a more meaningful way. And I think one of the key reasons that Iran hasn't done so and has mostly just, fiddled around with the chess pieces on the board and not really gotten involved in a meaningful way is that they don't really have the military capacity and funding to do so. And so in a world where Iran does in fact become involved and does back Hezbollah in a more meaningful way, we could potentially see Iran's allies also becoming involved, the likes of Syria. This could then mean that the regional conflict starts to spill over into a more globalized conflict involving greater superpowers like the US and China. Now, in that kind of world, and particularly one in which Israel could potentially destruct some of the oil infrastructure in Iran, would then push up the global price of oil. With higher oil prices comes through a bigger inflationary impulse, and then that would take away some of the interest rate cuts that central banks would be able to do. I think ultimately that kind of a world does mean a more stagflationary outcome where you have raised inflationary pressures, but also with higher rates of market volatility and higher oil prices, you could see a reduction in growth. And that is going to be a very difficult environment for central banks to operate.
In line with the topic of geopolitics, another factor which could potentially change the global economy is the US elections, which are coming up on the 5th of November. So we're seeing from the polls that it's quite a very small margin between Kamala Harris, although she's still leading now, and Donald Trump. So a lot of the outcome will depend on the swing states and what small voters in the swing states do. Do you have an idea of the possible scenarios of the outcome and how that could potentially affect the economy at large?
Sure. So if you look at the possible outcomes, it could range from, a red sweep where we have the Republicans in control of both chambers of Congress and led by Donald Trump, all the way to a blue sweep where we have the Democrats being in charge of both chambers of Congress with a Harris victory. We think that something in between is likely to come out, and we think that a split Congress is the most likely outcome. If we look at, the polls that you're suggesting, in the past, we've seen that polls haven't actually been all that accurate, and a lot depends on the swing voters as you get closer to the election date. And I think this time is no different with that. But I think this time around, our base case scenario And again, relative to the other scenarios, it's a very small margin at this point in time. But we're looking for a Harris victory with a split Congress outcome. Now, whenever you have a split Congress outcome, it means that a lot of the policies are watered down because you don't have both chambers of Congress agreeing on everything. Now, in that kind of a world, and potentially even in a blue sweep scenario, you would probably have more regulation, higher taxes, and markets don't like that because it's bad for corporate profitability. So that could be a slight market negative that comes through. Ultimately, this would be better for growth because under an environment that is more democratic-led, we would see a more positive environment for foreign policies and foreign affair matters. In an environment, I think, on the other end of that spectrum, which I think bears out the biggest sort of tail risk, is a red sweep scenario with Trump at the helm, almost a Trump 2.0 kind of scenario. Now, in that kind of world, there would probably be an easing back of regulation. He's already announced that he wanted to cut corporate taxes. That's great for corporate profitability. So we could actually see equity markets bouncing positively on the back of that. Ultimately, however, markets would become very worried about the tariffs that he wants to impose. As he's mentioned, a 10% across the board tariff, which would negatively affect emerging markets in quite a big way. That rise in protectionism and the rollback in regulation could actually be very negative for growth further down the line. The cutting of taxes could be very negative for the fiscal and debt outcomes, and we could potentially see with higher debt to GDP figures down the line that the legitimacy of the US dollar is tested in quite a big way. So while initially that kind of outcome would be quite positive for financial markets, I think further down the line the market will then cotton on to all of those risks attached.
So in general, we do see that there is a big risk of like populist policies, right? Which I guess is also something that us in South Africa experienced leading up to our May elections, where we had a risk of populist policies emerging in the instance that, for example, we had a coalition with the ANC and the EFF or the MK, and that would have led to negative implications such as negative economic growth, negative impact on the currency, and also potentially some backpedaling on private sector participation in the renewable and logistics space. Since then, we did see the formation of the Government of National Unity emerge, and that has been quite well received by the market. But there are still risks attached to that, particularly with the conflict of resolution agreements, which we've seen globally that GNUs that fail are failing because they don't have that type of agreement in place. So if there's still that risk, where are we gaining the confidence for growth going forward?
I think that there are some areas of structural reform where all the parties belonging to the Government of National Unity have broad agreement. And what gives me quite a lot of confidence in thinking that growth on a 3 to 5 year time frame might be better than what we're currently experiencing really emanates from the second term that has been granted to Operation Vulindlela. Operation Vulindlela is a project office that sits between National Treasury and the Presidency, and they've been looking at ways to cut regulatory red tape in areas like energy. You've mentioned the renewable space, in transport, in water, and a number of other industries. Operation Vulindlela's first term, they actually managed to tick off a lot of their objectives, and they believe that over that course of the 5 year term that we've already seen, that they've potentially unlocked about 500 billion rand worth of investment in the economy. So taking that into account and the fruits of those reforms, we could potentially get growth close to 3.5% by the time we get to the end of this decade. However, if we look at the interim growth numbers for this year and next, we are still hamstrung by certain structural bottlenecks in industries like logistics. So yes, while we've seen an alleviation on the energy supply constraints, we are still contending with water outages, we are still contending with port and logistic constraints, which is likely to keep growth at around 1% for this year and about 1.8% for next year. Operation Vulindlela's second term will also focus on things like spatial housing, fixing the problems at local municipalities, and this gives us quite an optimistic view on longer term trend growth for South Africa.
think with positive growth, we're also quite optimistic about the trajectory of inflation. We expect inflation to average about 4.7 this year and come down to 4.3% next year. So that is quite a welcome improvement from where we come from over the past 2 years. So with growth doing well and inflation trajectory heading on a downward trend, what do you think the SARB's next moves are from here?
With regards to the Reserve Bank in South Africa, we faced a very similar kind of market pressure that the likes of the European Central Bank, the Bank of England, and more recently the Federal Reserve have faced in terms of having to cut interest rates as inflation has fallen and as growth concerns start to emerge. Now, in the South African context, we need to remember that we are still an emerging market. And so here, inflation expectations are still very backward dated. And so we do run the risk of inflation expectations becoming de-anchored whenever there's an external shock that is imposed on the economy. And so I think, the Reserve Bank is on the right road to say that we will cut interest rates in a gradual manner to get back to neutral policy in South Africa, but being very cognizant of those upside threats to inflation that still persist, particularly things like electricity prices. So we're expecting another 3 interest rate cuts in the cycle. And of course, there's still this ongoing debate in markets of whether or not the inflation target will in fact be lowered to a number close to about 3%. And in that kind of world, it does also provide, extra caution on cutting interest rates too much and too soon.
It was lovely chatting to you, Sanisha. Just before we wrap up today's episode, I want to flag what we will be looking out for in the coming quarters. The first thing will be on the 30th of October. The Finance Minister will table the medium-term budget policy statement. Then we'll also look out for what we just spoke about now, which is the US elections on the 5th of November. Just 2 days after that, the Federal Reserve will announce its interest rate decisions, and that will be interesting to watch, particularly given the September payroll figures. Another matter that we will look out closely for is the sovereign credit rating decisions following the budget in South Africa. Thank you for watching. See you next time.